Most people think banks are avoiding crypto, but the truth, they're already using crypto rails every single day. You're just not supposed to notice. Visa launched USDC stablecoin settlements in the US in December 2025, with volumes reaching 4.5 billion in annualized run rate by early 2026. PNC partnered with Coinbase in December 2025 to allow private bank clients to buy, sell, and hold Bitcoin directly in their accounts. JP Morgan rebranded its Onyx blockchain platform in late 2024, processing over 1.5 trillion in transactions since launch and handling roughly $2 billion daily. Behind the scenes, the financial system is quietly shifting to blockchain-based infrastructure without ever calling it crypto. Stablecoin transactions soared to a record 33 trillion in 2025, up 72% from the previous year, with USDC leading at 18.3 trillion. And here's the part nobody is preparing for. When banks use these rails, your KYC requirements and tax records change with them, with frameworks like the Crypto Asset Reporting Framework set to roll out exchanges starting in 2027 or 2028 in over 75 jurisdictions around the world, and IRS Form 1099-DA reporting kicking in for 2025 transactions right now. Your financial data will be more interconnected than ever before. So here's the reality. Banks are already on crypto rails. We're entering a world where traditional banks don't adopt crypto, they absorb it. Think about what's already happening. Visa is moving money using USDC behind the scenes. No headlines, no hype. By mid-2026, their stablecoin settlement volumes will hit 4.5 billion annualized, a fraction of their 4.2 trillion total payments, but growing month over month. PNC Bank lets clients trade crypto directly in its app using Coinbase infrastructure. Launched in December 2025, this made PNC the first major US bank to offer direct spot Bitcoin trading to private clients. JP Morgan's Kinexys, formerly Onyx blockchain, has been used for tokenized commercial paper settlements like Siemens digital notes, and plans to add on-chain FX settlements starting with USD Euro in 2026. Launched digital asset custody in 2022 and expanded it to 2025 to include tokenized funds like BlackRock's BUIDL, which reached 2.5 billion in market cap by late 2025. BlackRock's BUIDL tokenized money market fund launched on Ethereum in March of 2024, grew to over 2.5 billion by November 2025, offering institutional investors US dollar yields with 24/7 transfers. Stablecoin systems now process hundreds of billions globally, with banks settling transactions faster and cheaper by simply not calling it crypto. Total stablecoin volumes hit 33 trillion in 2025, with Q4 alone at $11 trillion. This is not the future. This is now. Banks aren't waiting for permission. They're quietly shifting their plumbing to blockchains while keeping the same user interface so consumers don't panic or ask questions. For instance, SWIFT, the global banking network, completed trials with Citibank using blockchain connectors for synchronized fiat and digital settlements. Meanwhile, UBS piloted tokenized fund settlements with Chainlink and SWIFT, translating standard messages into on-chain instructions. Are you with me? Here's the danger no one talks about. If you don't understand how the shift works, you won't understand what your records need to look like going forward. Because when banks use crypto rails, your financial footprint becomes traceable in two systems at once: the bank KYC systems and the blockchain-based audit trails. And when those two datasets combine, your tax exposure becomes painfully clear. Think about it. Every moment is timestamped. Every transfer is traceable. Every inconsistency becomes an automated red flag. And the IRS already has new data pipelines being built to match traditional banking info with digital asset activity, including Form 1099-DA reporting for gross proceeds starting with 2025 transactions. And it's going to be filed in 2026. And the cost basis added in 2026. The Crypto Accounting Reporting Framework, with 75 jurisdictions committed, will enable global automatic exchange of crypto data starting in 2027 or 2028. If you're still keeping records like it's 2019, you're not just behind, you're vulnerable. For example, under the new IRS rules, brokers must report digital asset sales on Form 1099-DA, phasing in basis reporting by 2026, meaning unreported inconsistencies could trigger audits or penalties. Here's the shift and what it means for you in 2026. This new hybrid financial system creates three unavoidable realities. Your banking data will mirror blockchain accurately. Banks will use blockchain settlement layers that record transactions down to the second. Your statements will eventually need to reconcile with on-chain movement, even if you weren't the one using the crypto. With platforms like JP Morgan's Connexus enabling instant settlements and FX conversions, expect more seamless but traceable integrations. KYC, also known as Know Your Customer, becomes KY Everything. Banks will require more granular identity verification whenever funds touch blockchain rails. Even indirectly, expect enhanced checks, stricter documentation, and real-time verification norms. BNY Mellon's digital custody emphasizes bankruptcy protection and risk management, aligned with heightened KYC for tokenized assets. Tax records become far more scrutiny-ready, with systems like the Crypto Accounting Reporting Framework rolling out globally. Tax agencies will have unprecedented access to cross-border blockchain-linked data. Over 75 jurisdictions, including major crypto centers, have committed to the Crypto Accounting Reporting Framework implementation, with first exchanges in 2027 or 2028, like I alluded to before. In the United States of America, the IRS digital asset reporting via Form 1099 starts for 2025 proceeds, expanding to the basis in 2026. If you're not documenting correctly now, 2026 will expose the gaps automatically. Add to that the OECD's Crypto Accounting Reporting Framework, XML schema, released in 2024, requiring data collection from January 2026 in many places. These changes are not unique to the United States of America. This is a global adoption. How institutions are leading the charge. This isn't just a US story, it's global. Institutions worldwide are integrating crypto rails. Societe Generale and SWIFT settled tokenized bonds using the MiCA-compliant stablecoins in Europe, enabling near-instant settlements. State Street is tokenizing money market funds and ETFs, prioritizing regulated tokenized deposits over third-party stablecoins. HSBC and Abyssa use Ripple's custody for XRP, while US Bank and SocGen forge leverage Stellar for stablecoins. BlackRock prioritizes tokenized ETFs, aiming to tokenize $10 trillion in assets, with BUIDL already at $2.5 billion, and now accepted as collateral on Binance. These moves show banks adapting to survive, faster settlements, lower costs, and better efficiencies. But for individuals, it means your data flows across borders more easily, amplifying tax and compliance risks. So let's bring this all together. Where does this leave entrepreneurs and investors? You're entering a financial era where ignorance becomes expensive and strategic awareness becomes a superpower. The people who get ahead are the ones who understand how banks are using crypto rails, like JP Morgan, BNY Mellon, integrating digital assets, understanding what that means for their records, with IRS penalties waived for good faith 1099-DA efforts in 2025, but full enforcement looming, understanding how to adapt before regulators force their hand as the Crypto Accounting Reporting Framework exchanges begin in 2027 or 2028, potentially exposing cross-border gaps. And the ones who don't, they get caught off guard, usually during an audit, a loan application, or an immigration financial review. Here are a few real-world examples. Unreported stablecoin transfers could flag under new IRS pipelines, or tokenized fund inconsistencies trigger Crypto Accounting Reporting Framework exchanges. So if you're an investor or an entrepreneur and you want to learn more and you want to work with us, if this topic is new to you, or if you're curious but don't know where to start, you're exactly who we built our Numeratus ecosystem for. There's two ways forward. Join the Numeratus community if you want to learn, stay ahead of regulatory shifts, and understand these systems before they impact you. Our community is the perfect starting place. For $100 a month, you'll get weekly breakdowns of financial and crypto regulatory shifts, access to our weekly podcasts on the future of finance, deep dives on topics just like this, and access to people who are generally curious and leveling up. Or you could book a crypto accounting call at numeratus.us. If you're running a business, managing real capital, or preparing for cross-border or immigration-related financial requirements, and you want to actually implement a smart strategy, book a call. We'll help you structure your crypto treasury, prepare compliant records, and stay ahead of the changes banks aren't openly talking about. Because the system is changing. The question is whether you change with it or get surprised by it. I'll see you on the other side.